People are going to lose their minds. This is a moment in history unlike anything humanity's gone through. It's a very different world for humans to come.
Take a step back and see the broad picture, which is the way all these technologies are interlinked.
Because this is all about exponentiality, and humans can't think in exponential terms.
How consequential do you want to say machine intelligence is? It's almost certainly as consequential as writing. How long did writing take to disseminate through the human population? Hundreds, thousands of years. And we're dealing with it now on a scale of months.
But in this kind of world, you're compounding 100% growth every year, and the numbers become astronomical.
AI is going to spot patterns in the world that were just completely invisible to us.
Even if you think that the AI and the robots are your demise, you might as well bloody invest in them and make some money out of it. If not, you're just going to be angry man shaking your fists at the clouds.
Is the Fed finally done? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Joseph Wang, principal at thefedguy.com. Hi, Joseph. It's great to have you back on.
Hey, Maggie. It's a pleasure to be back.
So it has been quite a week. We had the Fed's decision to hold rates steady, a softer than expected payroll number this morning, a flood of earnings out, and the market has reacted. A huge swing in bond yields, the 10-year, which was sitting at 5% at times last week, all the way down to 4.57. Stocks, meanwhile, surged higher. The Nasdaq over 1% again today. The S&P very close to that. The Dow up over 0.5%. The Russell even participating up almost 3% today. And that rounds out what has been a string of very nice looking gains for stocks. I think it's going to end up being the best week for stocks this year. Before we dive into your thoughts about all of this, I just wanted to give a shout out to all of the guests who were on the Daily Briefing this week, who really telegraphed the possibility of this market reaction. Pay close attention. We're going to look at the highlights. Pay close attention to the date stamp on the videos, and let's have a listen.
Sitting in the mid 80s for Brent in particular is kind of the sweet spot for both sides. And I think absent any geopolitical risk, I think both the Saudis and the OPEC Plus in general would be happy with a low volatile oil price range bound between 70 and 90. In those price regimes, producers can make good money, governments can fund their fiscal obligations. The economy is not really thrown into much strain.
Stocks are vulnerable on the upside in the extremely short term. Like we said, with everybody short, we've reached some really serious support levels. We're, grazing through the Nasdaq's 200-day moving average, the same in the S&P. If we bounce from here from an oversold condition, just before we figure out what the next move is, it wouldn't be shocking at all to me.
The 10-year and 30-year yields, I think, are a steal. If you can put your cash away, you're going to see capital gains, I think, coming from being in it for a long period of time. So I think that's where you're going to be, whether you are looking for where you can get a high return or protect yourself in case of a storm, the storm being something happening to U.S. equities.
This has been a very thin, narrow market in terms of participation. The percentage of stocks, in the NASDAQ that were trading above their long-term moving averages, even while the NASDAQ was still well above its 200, was like 30%. That means that 2/3 of the NASDAQ was in a bear market, while 1/3 was dragging all the dead weight higher with it. Like, I want to see that dynamic completely reverse.
That was pretty good stuff. All of those were ahead of the event actually happening. So I thought they all deserved a little bit of a humble brag. But I think it's a case of really looking at the fundamentals, understanding policy, but also some of the market positioning and what's happening kind of underneath the hood, I think is really what sort of enabled them to see some of what was coming. Just great stuff. And that is the kind of content that is across the platform. So if you are listening on YouTube or audio and you are not a full member, come on over and join us at realvision.com. So Joseph, the question at this point with that great setup is all this enthusiasm justified? Is the Fed done hiking?
So in my view, of course, I think the Fed is done. And in fact, I think that rate hikes are probably going to occur faster than the market is expecting. At the moment, the market is thinking maybe sometime in the middle of next year. Now, to be
Wait,
perfectly
you
clear,
mean cuts? Fed cuts or Fed hikes?
yes,
Fed
cuts.
cuts are coming. Okay.
I th-
Wow.
so to be perfectly clear, when we listened to Chair Powell at his most recent meeting, he was not going to tell you that he was going to be done. He was definitely keeping open the possibility of future hikes. His theme in that press conference over and over again was that he believed that monetary policy is restrictive, but he doesn't know if it's sufficiently restrictive. So he's still holding out some possibility of a further hike. But I think that's becoming less and less likely going forward, and you can see that reflected in market pricing as well. I think there's a couple reasons for that. One is that, as Chair Powell noted, to some extent, higher yields, higher longer dated yields can substitute for rate hikes. Now, over the past few weeks, we've seen the 10-year soar, right? It's traded above 5% for a little bit. It's retreated notably, but it's still a lot higher than it was just a few weeks ago. Now, I expect that the 10-year yield to hold around this range for the coming months. And if that's the case, then I think that's enough to substitute for the last rate hike that the Fed had penciled in during their September dot plot. And the second thing is, it does seem like the data seems to be agreeing with the Fed in the sense that inflation definitely is trending in the right direction. We have, I guess, month over month basis, inflation has definitely trended towards, not there yet, trended towards 2%. We do see some very gradual softening in the labor market, like today's print, for example, which was actually okay, but across metrics, let's say headline, let's say unemployment rate, let's say labor participation rate, wage growth, all very, very slightly softer than expected. So that's heading in the right direction. And globally, of course, if you look around the world, in the Eurozone, in China, in the UK, it seems like we're heading into a global slowdown, and that should affect economic conditions in the US as well.
Yeah, so that's a pretty compelling case, and it's what the Fed's really been waiting for, right? Is some evidence they can do this. I'm curious if you think the reaction was expected. Did the Fed expect this kind of reaction when they announced they leave rates unchanged? And does it present a problem? Because even though the Treasury market was doing the work for the Fed, we've seen a really rapid turnaround now. And that's a big move for Treasury yields to drop that much from last week. Does this sort of immediate knee-jerk reaction sort of undo what they'd hoped for?
I think this reaction is what Chair Powell had in mind when he was saying that, yeah, longer dated yields rising could, to some extent, tighten financial conditions, but only if they're persistent, because he acknowledges that, there's a lot of volatility in the markets. As you noted, Maggie, the 10-year yield has been going up and down like a penny stock almost. So I actually think what's happening in the Treasury market is not so much a reaction to the Fed, although that plays a role, but I think the bigger driver is its reaction to the Treasury quarterly refunding announcement that was also made the same day. Now, in that announcement, again, there's a couple of things that I think were very supportive of the Treasury market. The first, of course, is that the U.S. Treasury said that they would probably only increase coupon sizes for one more quarter. Now, that's less than expected. Last August, they were telegraphing an increase over a few quarters. So again, going forward, that suggests that coupon supply, so the supply of longer dated Treasuries, is lower than the market expected. Now, the second thing, though, which I think is a much bigger deal, is that the Treasury seems to be suggesting that they're going to issue a lot more Treasury bills, so shorter dated Treasuries rather than longer dated Treasury coupons going forward. Now, the Treasury itself, they have a policy of issuing, let's say, between 50 to 20% of their overall outstanding debt in Treasury bills. Last August, they said that they would go slightly above that and go issue bills to, let's say, 22.4% of overall marketable outstanding. Now, this past statement, they seem to strongly suggest they're even willing to go above that. Now, what they're doing then is that they're issuing fewer longer dated Treasuries, which so there's less supply. They're the long end, let's say 10-year, 30-year, and that's supportive of Treasury yields, just basic supply and demand. And instead, they're going to issue more Treasury bills. And there's tremendous demand for Treasury bills right now for money market funds. So it does make sense as a policy to do that. It's not something that will help forever, because eventually you're going to get too much issuance in the front end as well. But I think that's a few months away, maybe after November or something like that.
That's so interesting. And the mechanics of the auctions and what's happening with supply is really important right now. So do you think this is just a really sort of savvy way of being a market participant, understanding that they can do this? Does it carry any risk?
Now, there's a couple of ways to think about this. So first of all, Treasury has a tradition of being a principled actor. They don't want to time the market. They have a principle of being regular and predictable, and also a principle of issuing 15 to 20% of their total issuance in bills. So this is a departure from what they've been doing over the past several years, and I think it was a surprise to some people. So if you're the government, you want to move slowly and predictably, and you don't want to surprise people. So I think from that perspective, this wasn't a good move. But from a market participant's perspective, it is actually quite clever because right now we have tremendous demand for Treasury bills, but obviously not a lot of demand for longer dated Treasuries, which is why Treasury yields have gone up so much over the past few weeks. So this maneuver here is going to give more stability to the markets. I think it's a major contributor in the big rally we see in the 10-year. And of course, if we have stability in the Treasury market, that's positive for equities. And I think that contributes to the equity rally we've seen this week as well.
Yeah. So have we seen now the peak in Treasury yields?
So for the year, I think so for the year. But my own perspective is that we are in a paradigm shift where the future will not look like the past. So if you think back over the past few decades, we've had a tremendous bull market in Treasuries. So the yields basically just went steadily downwards since the 1980s. I think that all reverses. It's really easy to see how that could be the case if you just look at Treasury supply, which at the moment is projected to be, let's say, 1.5 to 2 trillion a year forever. Now, that's based on current law, and as we all know, current law can change. It usually only changes to one direction, though, that is to say, even more government spending. So it's likely we'll have even more issuance. And if you add quantitative tightening on top of that, the private sector is going to have to absorb over 2 trillion in Treasuries next year, actually closer to 2.5 trillion next year, depending on how long QT goes. That's a tremendous amount of supply, and I don't think the financial system is flexible enough to absorb that at current rates. So I expect that even though we got some temporary reprieve from maybe a little bit slower data, from the Treasury's announcement, and from a Fed that was interpreted to be dovish, I think in a few months, maybe sometime in the middle of next year, these problems are going to resurface again. They're not going away. The only way they can go away is if Congress spends less money, and I don't see that happening. So Treasury yields have only one way to go in the medium term, in my perspective, that is up. Unless, of course, the Fed wants to step in and do something about it, but we're not there yet.
Which would be yield curve control, which
Something
would be
like
to put a
that.
cap, to somehow to put a cap on. So you say it very calmly, but the massive implications if we have Treasury yields that are going to trend higher and just maybe get these little, I think somebody referred to it as pushing a beach ball down, a little reprieve where you get yields to go down, but they're going to pop back higher because you have this mountain of issuance and debt that we just can't get around. What are the implications of that for the economy?
So actually, I would actually think that it's probably not going to be as bad as expected. And because the reason that yields are going higher is because of tremendous supply. And the reason that you have tremendous supply is because you have tremendous deficit spending. Now, deficit spending is stimulative, is supportive of the economy. It does depend on how the money is being spent. But on the one hand, the government continues to add money into the system that is supportive of cash flows, and that means people can continue to service their debt even though interest rates are going higher. Now, there's going to be some fine-tuning to this, of course, because how high yields go is in part due to market liquidity. So you could have yields go much higher than even the increased deficit spending being supportive of the economy can help. And if that were the case, I would expect the Fed to try to either do some sort of purchasing operation to support the market, or maybe some sort of yield curve control. Again, that's something that is in the medium term. We're not there yet. We probably have to go through a normal slowdown cycle, however slight it will be first.
Yeah. So if we think about that, it's a great point about the fact that it'll stimulate the economy. I guess when we talk about the impact, it depends who you are, right? So if you're in the economy, if you're somebody who's benefiting from the stimulus, if you're a manufacturer who's getting funds, or you're building a road and there's government spending for that, defense, wherever that money goes, that'll be a benefit. If you're somebody who owes, though, who needs to borrow, that's really problematic. And presumably that's what Jamie Dimon was alluding to when he said the world cannot operate at this level of sort of structurally higher rates. It's not set up for that from a credit perspective. Is that being overly gloomy, or is it a problem? Because we see commercial real estate. We know a lot of people are locked in 30-year mortgages with low rates, but eventually these rates reset, right? We're sort of seeing a little bit of a strain. Is that a problem for credit markets?
So I think you're targeting exactly the right thing. There's some distributive effect of this, right? Let's say that you are someone who doesn't have, let's say, floating rate debt, then you're probably not going to be affected by this. But if you have floating rate debt, you're going to probably have to renew at high rates, and that's going to squeeze your cash flow. But I would also take a step back and think about this over the past 2 years. Over the past 2 years, people have been saying that the system cannot handle higher rates. This is not acceptable. Something's going to break, and so forth. And fast forward to today, well, last quarter we had real GDP growth of 4.9%. So I'm thinking that mental model, maybe there's something changing that mental model is not accounting for. And I think what it's not accounting for is that when you have tremendous deficit spending, you're injecting equity into the financial system. And so even though you have higher interest rate expenses, you can also afford it. Now, there will be pockets of stress for sure. And we see that, for example, in commercial real estate, although I suspect that has more to do with a revenue problem where you have a lot of people working from home. And so a lot of the restaurants and so forth cannot operate. So I don't feel that's purely a rate problem. Now, let's say that everyone went back to work. Well, if you have significant deficit spending, then you have more revenues, more cash flows. It is modestly inflationary as well, depending on supply constraints and so forth. So they would be able to afford higher rent, which in turn means that they can afford higher mortgages on their real estate. So I would just point out that things still seem to be going okay, even though interest rates have risen significantly.
That's such an interesting point, and it's a good way to flip it around, because we're all sort of waiting for, some people have suggested that the fact that we're all waiting for something to break and waiting for this catastrophe, maybe there's some recency bias in there because of what happened with the great financial crisis. And, it's the recession that everyone's sort of been looking for, dying to get to in a way. So if we think about that with that government spending, do we see a recession? Do we see a credit event? It's possible that neither happen?
So we will definitely have a recession. Recession it's a business cycle. It's part of human nature almost, right? So you think the good times last forever, you will overextend yourself. Good times don't materialize, or at least not to the extent that you expected, and so you retrench a bit. But I think it's really hard for me to see a serious recession going forward. One, of course, is because this remains tremendous amounts of spending by the government, deficit spending about 7% right now, that's supportive. But more importantly, so I think what the policymakers have learned in 2020 is that if there's anything bad happens, you can always just spend more money and it will go away. So if you think back 20 years ago around the great financial crisis, there was a lot of reluctance to engage in tremendous amounts of government spending. There was talk of stuff like moral hazard and things like that. That stuff is all gone now. Everyone is on board that the magic solution to any economic problem is to just spend more money. The side effect of that is, inflation, but I think that they're able to stomach that. So if we ever have a serious recession, I would expect them to open up that same playbook. And so the recession wouldn't be very, very deep. Of course, this also suggests that going forward, inflation should be higher than it was in the past 10 years.
Yeah. So potentially structurally higher inflation, structurally higher interest rates, that sort of environment. Doug, I think that answered the question you asked about the slowdown resulting in a recession. But Joseph thinking maybe not a severe one. Jake has a great question. Does the declining reverse repo balance increase overall money supply and ultimately inflation? Can the RRP running dry be the nail on the coffin for inflation and possibly overshoot?
So there's a couple points in that question. One is that the relationship between the RRP declining and money supply, and the second is between the money supply and inflation. So as the RRP runs down, yes, it will increase money supply. What's happening is that the money market funds are taking money out of the reverse repo facility, lending it to the government, and the government then spends it into the private sector. And when the government spends, it ends up in someone's bank account. So it will increase M2 money supply. But I would be cautious about the link between money supply and inflation. So in the 1980s, there were many people who thought this. At the Fed, they invented M2, M3, M4, M5. Everyone tried to track that, and it turned out to not be very useful. I will also note that more recently, there are some important people making some more research suggesting that, yeah, maybe there is sometimes some link. I don't know, but I don't think it will be a big impact on inflation. Just looking narrowly at between M2 and economic activity, I think of the rise of an M2, in my view, is more linked to financial assets, because when people have money, they don't really necessarily spend it on goods and services. In fact, they tend to spend it on assets, since it tends to be the wealthy people who have most of the money.
Interesting. On that point, Philip asking, increasing credit card debt, especially with the bottom half of consumers, sort of the worry is that there'll be lower spending coming. Do you see that, and will that impact company profits?
So on social media, I do see people post that image of soaring credit card balances. I think it's over $1 trillion now. But I don't think that's the right comparison, because you have to notice that credit card balances is nominal. And over the past few years, we've had an inflationary period. Prices of everything have gone up. When you normalize that by disposable income, you get a very, very different picture. So when you normalize credit card balances by total disposable income, you'll note that it's actually trending. It's actually historically quite low. So that's what you want to keep in mind. So yes, credit card debt has gone up, but so have incomes as well. So I don't worry about that.
As much. I love that. It's so important. Thank you for that answer, Joseph, because I think that you can throw anything on social media and create a lot of, this is the thing with sort of charts and statistics. If you have no context around it, they can suggest a narrative that, there may be other information points, data points that are needed for that. So, Philip, I hope that answered your question. I think that was great to jot down in your notes, people. If you're on the platform, tag that and put it in your notes, because that's going to be something that you need to remember in the future. We also had some movements on the Bank of Japan, Joseph, that I wanted to ask you about, because, of course, the Fed's not the only central bank in the world. And we have been in the situation where everyone's been trying to get inflation under control. A lot of questions both about the ECB and BOE as well. But Bank of Japan sort of signaled that they'd be making a big change. They were the last holdout with yield curve control. And they indicated that they would be, at least tweaking it and being a little bit more flexible on that. Do you think that's possible? Because once you signal you're not going to hold a firm line, the market tends to test you. So how do you see that happening, and what is the impact for the rest of the world?
I think that they're breaking out champagne that we had a big rally in Treasury, so that it have to be tested this week.
That's right.
But you're absolutely right, Maggie. That was the big event earlier in the week, the Bank of Japan. Well, first there was a leak by Nikkei News about the potential for the Bank of Japan to, loosen up their iron grip on yield curve control, and indeed that's what they did. Now the target is still 1%, but now they're not going to commit to unlimited buying there. They're just, I don't know, I guess they're trying to just buy some so that it stabilizes it a bit. So I think it hasn't had so much a huge impact yet because that 1%, that wasn't a binding ceiling at the moment. Now, psychologically, again, it's the Bank of Japan telling you that they are tightening monetary policy, and the market will look at this and expect that the next step would be an exit out of negative interest rates. So believe it or not, Japan is still in negative interest rates. So overall, it's both the beginning of a tightening phase in their monetary policy. And totally makes sense. If you look at Japanese inflation numbers, they've been comfortably above their target for several months now. So it makes sense for them to tighten up a bit. I think that the impact, though, insofar as it spills over abroad. So usually when we think of sovereign bond markets, they are tightly connected. I think it's going to be a little bit less connected this time. The reason being is that I don't think there's a lot of people, the connection between Japan and US is as strong as it usually is, because usually you would have a lot of people from Japan, say, buying treasuries on an FX hedged basis. Now, if this move happened when that was still the case, then you can think of maybe people getting out of their trade in treasuries and going back home to Japan, where they could get higher yields on their JGBs. But the FX hedged treasury yields haven't been attractive for some time because the US hiked their short-term interest rates so much. So I think that's going to limit spillovers a little bit.
Oh, that's interesting, because a lot of people are worried that what's happening in Japan could be another factor that puts upward pressure on treasuries, as everyone kind of unwinds those yen carry trades and stuff like that. But maybe, as you say, there's been some of that happening in a more orderly manner anyway because of market conditions. Go ahead.
So two things there. So Japanese investors buying US treasuries can do that on an FX hedged basis or just without any FX hedge. Now, that FX hedge trade hasn't made sense for a long time because of the shape of the US curve. And so I don't think there's a lot there to unwind for them to sell treasuries and go back to Japan. There could be some people there who are just buying treasuries without any FX hedge, and they would want to go back to Japan to buy JGBs once yield curve control is totally over. I don't know if that's the case, though, because my sense is that if you're buying treasuries unhedged, part of that is a currency play. So they wouldn't be like all about yields.
So Ralph asking, what durations are you bullish or bearish on?
Yeah, so I like shorter duration treasuries. So let's say within 2 years, because my expectation is that the Fed will probably going to cut rates maybe March of next year, not because there's some huge shift or anything like that. It's really about fine-tuning monetary policy. So inflation is trending lower, and at least as we discussed earlier, for all these reasons of softening economy and so forth. And the Fed looks at the world through the lens of real interest rates. So real interest rates are nominal minus inflation. As inflation trends lower, just to maintain real interest rates, I think they would make sense for them to just kind of cut a little bit to adjust that, to keep real interest rates constant.
So you don't worry that, and J&J, I think that answered your question. What would cause the Fed to step in? So you're just saying that they're going to see their target come down, the economy start to weaken, and they're going to provide a little bit of support for the economy. The market seems to have such extreme reactions when they do that, though. So are they, if we're in this sort of deficit spending, higher inflationary, that's the sort of risk that you describe. Is there a risk of the Fed acting too early? I mean, Powell has taken such great pains to say he doesn't want to be Arthur Burns, right? Why not just hold rates steady if that's the case?
So if you hold nominal rates steady as inflation comes down, what you're effectively doing is you're basically making monetary policy even tighter, even as inflation is going towards the right direction, even as the economy is slowing. I don't think that makes sense. I think that as inflation comes down, as the economy slows, what you want to do is gradually reduce the amount of tightening that you've done. And so you could do that by making sure that real interest rates don't stay level as inflation comes down. And I think you're exactly right that this is going to be a communications challenge because everyone will see that and perceive, Fed is loosening financial conditions, time to go buy Dogecoin and all that stuff. But I think it's a communications challenge that I think that they can do. I think they've been laying the groundwork for that over the past couple months in a lengthy discussion, teaching people about what real interest rates are. So I think they can succeed in doing that.
So does the Fed actually have a shot here of engineering a soft landing?
Maggie, I think we already are in a soft landing.
Yeah, that seems to be
Come
what
on,
you're
let's
saying.
take a look back. So what is a soft landing? So inflation coming down without a recession. And is inflation coming down? Absolutely. Still above 2% to be sure, but it is definitely coming down. Now, what about economic growth? Well, it's actually accelerating. It's actually accelerating in a very big way. I don't expect the third quarter to repeat, but we're still growing above trend. Unemployment is still low. So this is a soft landing. We're living in it. Don't need to doubt it. Can change in the future, but so far we are living in soft landing world.
Wow. Well, that would be the Fed sort of defying its own statistics in that case, because they haven't been able to do it very many times. But it seems like they're evening out the scorecard, at least this time around. Joseph, I can't think of a better Friday to have you on, given everything that happened with the market and your sort of deep understanding of monetary policy. Thank you so much for that.
My pleasure. Thanks for inviting me.
Thanks. Have a great weekend. Have a great weekend, everyone. Hope you enjoy. We'll see you back here. I am out for work traveling next week, so Ash is going to be manning the desk, as it were. But everyone have a great weekend and a great week. I'll see you on the other side. Take care and good luck out there.
People are going to lose their minds. This is a moment in history unlike anything humanity's gone through. It's a very different world for humans to come.
Take a step back and see the broad picture, which is the way all these technologies are interlinked.
Because this is all about exponentiality, and humans can't think in exponential terms.
How consequential do you want to say machine intelligence is? It's almost certainly as consequential as writing. How long did writing take to disseminate through the human population? Hundreds, thousands of years. And we're dealing with it now on a scale of months.
But in this kind of world, you're compounding 100% growth every year, and the numbers become astronomical.
AI is going to spot patterns in the world that were just completely invisible to us.
Even if you think that the AI and the robots are your demise, you might as well bloody invest in them and make some money out of it. If not, you're just going to be angry man shaking your fists at the clouds.